know that lease deposits might also be construed as financial instruments? That now both losses and gains on derivatives will have to be P&L'd. And there's also the derecognition of financial instruments to worry about. Hello and welcome to Mind the Gap. This week, we continue our discussion on the new Indian accounting standard on financial instruments. And later on in the show, we'll also talk about share-based payments, including ESOPs. Last week on Mind the Gap, we discussed the new Indian accounting standard on financial instruments. Corporate fundraising will now have to account for substance over form. For instance, equity shares with a put option will be accounted for as debt. The same applies to redeemable preference shares, whereas compulsorily convertible debentures will be counted towards equity. We also discussed fair valuing equity investments, a reality check for intra-group loans and guarantees, and the impact of the expected loss model on doubtful debts. This week, we continue our conversation on financial instruments, specifically derivative and hedge accounting, non-traditional instruments, and the derecognition of financial instruments. Let's start with derivative and hedge accounting.
I think I'll touch upon the two big changes. One is today we account for derivatives only for certain foreign exchange derivatives, right, and not for all derivatives. Right. So if you have commodity derivatives, interest rate derivatives that a company may have taken, they never get reflected. As compared to that, all derivatives will get covered by the accounting going forward. That's one. Right. Okay. Second, the big change is that today the model is even for foreign currency derivatives, if there's a loss, you account for the loss. If there's a gain, you ignore the gain, which is only losses are on a notional basis. Going forward, both gains and losses will be recorded in the P&L. So all derivatives reflected in the financials, and whether it's in a positive position on a gain or a negative position on a loss, both of them will show up in the P&L.
I will just add to what Jamil is saying. So one is derivative in its simplest form, what we understand, which is, let's say, over the counter is what we have, where we have an intermediary, which is a bank, which is selling these derivatives. That's what going to get accounted through fair value, either through profit and loss account or otherwise. But what is the other thing which is going to impact a lot of companies is to identify derivatives which currently we may not even realize that these are derivative instruments. For example, if you enter into a long-term supply contract, okay, and let's say it's a commodity supply contract, and you are in a practice or you have a habit of settling this on a net basis with the counterparty. So that contract today is accounted for based on the terms of the contract. So whenever you receive the supply, you account for it, or whenever you settle it net, you account for it. Now the new standard will expect you to also evaluate, is this also, this supply arrangement, is this also a derivative arrangement? Because you have the variability, which is the price. You have not paid anything to get into this contract, and this is going to get settled. And if the likely settlement is on a net basis, then this may also become a derivative, and you may end up doing fair value accounting for this.
And what this will do once again is to get companies to really look at their practices again. So we be dealing with a similar situation where a zinc company has certain commodity contracts to purchase the input material on the zinc. They have settled net on many occasions, which is resulting in them being treated as derivative, even though that is normally for the purchase in the production process, right? Okay. What they're now realizing, this is the adverse consequence. Really, do we have to settle on a net basis? Is it not? Should we only take derivatives which meet our requirement for production and avoid, in a way, cancellations which could result in a derivative treatment? But in my experience, the big ticket one is going to be the volatility, because of the fact that gains on mark to market of interest rate, commodity and foreign exchange derivatives will now start seeping into the P&L.
Is the treatment for hedge accounting any different from what we've discussed with regards to derivatives?
Yes, absolutely. So hedge accounting as a concept has not been applied by a lot of Indian companies so far. But now I think with the objective of that all derivatives anyway you have to fair value and take it to the profit and loss account, a lot of companies will now explore the possibility of doing hedge accounting. So what hedge accounting in a way will help the companies is to record the gain or loss on derivative at the same time when you want to record the underlying transaction as well. So but you still have to do fair value. The impact of fair value then will be parked in a capital account, again in your balance sheet, which will be reclassed to the P&L as and when such hedge item, which is let's say a forecasted sale or a forecasted purchase, is going to get recorded in your P&L. So in a way this will balance, and this will also reflect the management strategy. So if I am the management, I want to lock myself for next 3 years. Look, these are the sales I am comfortable with, this is the realization rate I am comfortable with. Exactly the same thing will appear in your P&L. So that will help you to position to your investors, and if you want to give a guidance, some of that you will be able to do it with a lot more certainty, but provided you're hedging your risk appropriately as well.
Okay. I again ask you for the optics of this, right? When we are looking at earnings next year, when this is applied to derivatives and hedge accounting, is it going to mean that we are going to finally see the gains come into the P&L as well? So actually this will be a plus or a good thing, because till now we were only seeing the losses. Now everything gets fair valued. How does one understand what the broader impact of this is going to be?
Yeah, I think one thing we will see is how much are you in the money or out of the money on your entire derivative position. Whether it shows in the P&L or not, on the balance sheet you'll see I've got a mark-to-market asset which we never saw earlier, or a mark-to-market liability for elements including commodity and interest rate derivative that you never saw earlier. So the balance sheet is an important thing to watch out for. Second is it will be the point on volatility. Even today there are companies, so if you contrast two companies, if you contrast Infosys and Wipro, Infosys takes a view to say we will mark to market everything in our international GAAP and take it to P&L. That's their philosophy, that's the way they run it. Wipro on the other hand could take a view that I want to follow, or we want to follow hedge accounting, in which case balance sheet remains the same, but the volatility is not in the P&L, you park it in reserve and you recycle it at the time when the sale actually happens. So you will see a lot more disclosures around that. You may see volatility.
It won't be uniform though. Different companies could
adopt different kind of policies and practices. So that is something that we need to be prepared for. I want to add one more element to this, which is and this is one benefit out of the new IFRS 9, or leapfrogging the current set of IFRSs. Earlier, if you wanted to do hedge accounting, you would be restricted in the type of instruments that you use to plain vanilla forward contracts. Options, for example, were not suitable for doing hedge accounting in the past. The new standard lets you use options as well in many cases. So some of the discussions we've been having with companies is to say that, look, we had tied into certain types of instrument because we wanted to get hedge accounting under the old model. Now if we have more flexibility, should we relook at the type of instruments that we use as well? Right? So that's something at the company, at the business level, but from an investor perspective, look out for the asset and liability, which is your gain or loss position, and look out for the volatility in the P&L as well.
Yeah, I just want to add here that hedge accounting also required a lot of discipline. So companies will have to actually put together very strong processes to do this on an ongoing basis. Otherwise, Otherwise, what will happen, let's say, so as we said, the gain or loss will go to P&L, but if you do hedge accounting, it goes to capital in the intermediate period. So if the standard expects you to put the documentation at the point in time you're getting into the contract, because if you don't follow that, a management may time it to say, if I'm in the money, I'll take it to the P&L, but if I'm out of the money, I'll better park it in my capital account and then take it to the P&L.
So it could be a governance gray area.
It is.
It is a governance gray area. Because you now have the flexibility to pick the routes that you want. The last 2 points I wanted to come to. Jamil, you were talking about non-traditional instruments, and I'd like you to elaborate on what you meant by that and how this standard applies to them.
One of the things that people who apply the new standard will realize is you do not see certain things that financial instruments, but the standard requires you to do that. So take the simple example. Take the simple example of a retail company or a bank which has a lot of branches or a lot of retail outlets. For each of these outlets, you would have paid a lease deposit to the lessor. Today, it's interest free, and you park it as a lease deposit as an asset. IND-AS says that that's an interest-free financial instrument, and ideally you should have earned some instrument on the deposit which you're now not earning, and that's another form of paying rent to the lessor. So on day one, if I place a deposit of 100, let's say for a 1 year period, the fair value of that will be determined to be 90 because it's not interest bearing.
Correct.
the difference of 10 will be recorded as an additional rental that I'm paying the lessor. So my rent expense is a cost. My rent expense will go up because I will have the normal rent that I pay plus this 10 rupees of notional rent. Of course, that will be offset by the fact that now this is treated as an interest-bearing asset, so I'll record a notional interest income as well in the P&L on this 90 that I've recorded. But what we are seeing in practice happen, so this may be P&L neutral to a large extent, but it's different geographies in the P&L. And many of these companies measure themselves on EBITDA. From an EBITDA perspective, it comes down because rental expense goes up, but interest income offsets that, which comes below EBITDA. So I think there are some very interesting plays, and the point I would like to leave behind is you would not have thought of this as an instrument which could result in so much complexity for you, so much work for you, because again, imagine a bank which has 8,000 branches or 5,000 branches or whatever. To do this on a deposit by deposit basis for every security deposit you play would have a big impact on how you do this function.
Is this the only type, or are there more in this category that you've discovered, but you're using this as the only illustration?
I'm using this as an example because what I want to
But there are several more.
Yes, so similarly, if you have, let's say, an interest-free advance to an employee that you pay, the same concept applies, that in a way that's more salary you're paying the employee, so your compensation will go up. It could have its own impact on how you deal with that.
And similarly, if you have a longer term payable, let's say you're buying a piece of machinery for which you have a longer term payable. So today, let's say machinery cost is 100 and the payable is 100. You simply capitalize asset at 100 and payable at 100. Now you'll have to discount it to the present value, and again the impact of that will hit your purchase cost as well as your carrying value of financial liability.
Wow. Okay.
So I also like to just add one more point on this whole expected credit loss model we discussed. So this also gets extended to these lease deposits. Now you have to also apply and provide for a possible doubtful debt on not only your receivables but also on your other financial assets which are not recorded at fair value. So if you're these lease deposits, again you're doing amortized cost accounting, you'll have to again do expected credit loss. If I have 100 such lease deposits to a tenant, to a landlord, how much of it can possibly go back? Very common issue, let's say for a telecom tower company.
As in the landlord will not return the money.
Possible, right? You will have disputes,
So you now have to forecast that, model that and factor that in, is
Absolutely, and provide for it today instead of waiting for the loss to occur.
Okay, that's complex. I'll ask you about derecognition of financial instruments because that is the last important point that we must include.
So let me again give you a simple example. Let's say today I have 100 rupees of receivables in my balance sheet. I want to go to a bank, I need cash, but I have this receivable. So I go to a bank and say, I want to sell my receivables to you, will you buy them? So bank will say, okay, I will buy them. If it is 100 rupees and let's say I expect the payment to come in 6 months. So bank will pay me, let's say 94 rupees, he will charge my 12% rate of interest, they will pay me 94 rupees and I will assign the receivables in favor of the bank.
Okay.
But bank will say, hey, I'm not sure whether your debtor will end up paying or not. Okay, so I want some kind of guarantee from you. Okay, so the seller will end up giving a guarantee to the bank. If this guy will not pay, I'll make good the loss. So today what I do, I simply derecognize my debtor because I've already sold the receivable to a bank and I record the cash of 94 and this 6 I charge it to my P&L, possibly as a little loss on sale. In future, what I will be required to do, because I have given this guarantee to the bank, I have not transferred the underlying risk and reward of this debt instrument. So I will not be able to derecognize this receivable. I'll end up recording 100 rupees of receivable, 94 rupees of debt on my balance sheet, and 6 rupees as an interest cost, which I will end up recording over the period of time, in that sense. So this 6 rupee loss which is going to hit me today, now in future will hit me over a period of time, but my balance sheet will be grossed up. So my debt equity possibly will look very different in future than what it is today, in that sense.
Okay, last comments, and Jamila, this is the 4th episode we're doing. I'm not an accounting person, but I found it fairly easy to understand the first 3. This has proven to be challenging. This is going to be the biggest and the most challenging area, you would say?
I think I'll say 2 things. One is, once you get to the root of the issue, a company will need to determine what are the instruments they are exposed to. So in many cases we have seen where companies have very traditional forms of funding, very traditional investments and no derivatives, then you end up to some operational complexities around things like lease deposits, etc. So that's one set of companies. But then there are companies, particularly with the large business groups, which have a lot of these instruments on all sides that you kind of covered.
Maybe infrastructure is a good example of this.
Infrastructure, large conglomerates, etc. That's where it becomes a very big problem. The second comment I'll make is some people get very apprehensive about the standard as well. So my advice to all my clients really is that, look, just because it's a very large and complex standard does not mean all of it applies to you. Narrow down to what you believe is relevant and then kind of do a bottom up. And the only other element why this becomes more complex is because it's not something we've ever done before. So revenue we've done before. We know what revenue is. Leases, we know what leases is. This is a completely new area, and that makes it so much more difficult to implement.
If you were to list the 2 or 3 changes in corporate strategy, because of the application of this new standard, what would they be, Sandip?
So I think the companies will have to take a decision on what is it they want to do with their derivatives. Whether they want to take the derivatives to capital account or they want to take it to the P&L account, as what, let's say, Infosys is doing and what Wipro is taking the other route. That's one decision which companies will have to do. The second is that all the different types of fundraising instrument they have, I think companies will have to figure out, hey, is there any merit in me doing such complex structuring, spending a lot of time with so many lawyers, figuring out the right words into all of this,
because the benefits of all of
benefits
that are there virtually now.
Is going away in that sense. And the third thing is that how do we put together the whole mechanism to manage all of this on a go forward basis, because it is complex and every company, as you said, has large number of financial instruments to deal with.
Coming up, we discuss the accounting changes to share-based payments, including ESOPs. Welcome back. You're watching Mind the Gap. The new Indian accounting standards provide extensive guidance on share-based payments, including ESOPs. To find out what has changed vis-a-vis Indian GAAP, I have with me Sumit Seth. He's partner and IFRS leader at Pricewaterhouse. Sumit, lovely to have you back on the show. Let me start by identifying the biggest area of change, and that has to do with the mandatory use of fair value now in all share-based payments, including ESOPs.
That's right. So I think consistent with the entire IFRS framework, where you have to use fair value method of accounting, even for share-based payments, whether it's for employees or non-employees like service providers, you have to now use the fair value method to account for that. To try and explain, so if you look at employee stock option plans, employees are given options for the services they provide.
Right.
In that context, presently under Indian GAAP, companies could use the intrinsic value method or the fair value method. And typically, companies use the intrinsic value method, which didn't have any expense recognition.
Right.
But now under the IND-AS, companies have to necessarily use the fair value method. So you'll see increased reporting of stock compensation expense in the income statement.
There are different kinds of ESOP schemes available. I know you were pointing out that when you have graded vesting, there is an additional impact that takes place. Can you talk us through that?
Right, sure. So typically, if you look at some of the plans which companies have used, you have a vesting period, say for example 3 years, and in these situations, the options they vest on a pro rata basis. So for example, in the first year you will have 30% of the options vesting, another 30% and maybe 40%. So it's like kind of going over a period of time. And the Indian GAAP presently is company could have an option to recognize the entire expense on a straight line basis. But in the IND-AS, you have to do a graded vesting and attribution of expense. So what that means is the fair value for each tranche. So in my example, let's say the first 30% will be recognized over a 1-year period, the next 30% over a 2-year period, and the last 40% over a 3-year period. So what that means is there's more upfront recognition of expense and linked to the actual services which employees are providing. So you will see higher expense in the earlier years, and then it kind of tapers off.
Okay. What about ESOPs that you grant to employees of your subsidiary companies?
Yeah, that's a very good point actually. So typically, if you look at a lot of MNCs, you have foreign parents, they have Indian subsidiaries, and many of these use share-based plans or programs of the parent company. I.e., the parent would provide its shares to the employees of the subsidiary. So presently, again, the Indian GAAP, you will not really see the Indian entity, which is the subsidiary, recording any kind of stock compensation expense, because you're not using the shares of the Indian subsidiaries, the parents' shares. But again, under IND-AS, IFRS, you would see these entities now recording stock
so
compensation.
So the subsidiary itself will have to record the cost?
Absolutely. So now, if the subsidiary is using the parent's shares to incentivize its employees, then you would see an expense in the income statement of the subsidiary.
So with another area of change or impact is, trusts that typically hold these option schemes, so to speak, or the shares that are distributed in option schemes, they now have to be consolidated. What does that mean, and can you explain the impact?
Sure. So absolutely. So now when you have these trusts, and these trusts are holding shares for the benefit of employees.
Correct.
Under current Indian GAAP, these trusts were not consolidated. Now going forward, of course, these trusts would typically get consolidated as part of the entity's consolidated financial statements.
Correct.
So what you will see is that typically when you have these trusts, the entity is providing a loan to the trust to buy these shares, and so the loan was coming as an asset on the balance sheet. Now when you consolidate, this loan will go away and it will get adjusted against equity. So I think to that extent, it will become part of the consolidated financial statements, and net worth, right, will of course reduce to that extent. From an expense recognition perspective, I don't see much of a change on this account.
Okay. Fourth area of change, or fifth area of change, would be the impact on taxes?
Yes, absolutely. So from a tax perspective, I think two implications. One is MAT, now stock compensation expense will become an expense in the income statement. So of course it impacts MAT liability. I think it's a relief, because there will be expense in lower accounting profits. The other area is transfer pricing. When you have transfer pricing arrangements, in a sense, arrangements with your parent and related entities, and typically we see it in cost plus entities, where revenue to the parent is based on cost plus a margin, and then that's what you bill to your parent. Now when this is part of the cost, what you would expect to see is, of course, this cost plus margin, and therefore higher revenues. So I think companies, will have to look at some of this, especially in the context of their related party transactions going forward.
Okay. As a combined effect, does this serve to make ESOPs or share-based payments, the full family of them, less attractive?
I think earlier it was lucrative. I would just say that in the sense it didn't have any accounting consequence. Companies had an option not to recognize an expense. But I think going forward, really speaking, that will go away. So companies will have to expense based on fair value. So that kind of decision, is kind of done away with. So really companies will now evaluate, whether they want to use this truly as a basis to retain employees, so that they have a kind of a skin in the game, right, and long-term retention. And I think that will be the key driver now, going forward, instead of just from
all the other accounting
exactly
stuff. All right, Sumit, thank you very much for speaking with us, and thank you very much for watching. Next week, Mind the Gap will be back. We'll be discussing combinations.